Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Nvidia will invest as much as $100 billion in OpenAI to help build more data centers. Nvidia shares closed nearly 4% higher. Newly appointed Fed Governor Stephen Miran explains his push for aggressively lower rates in alignment with President Trump's position. Fed Chair Jay Powell is expected to speak later today. Plus, Super Typhoon Ragasa barrels towards Hong Kong, threatened to be the most damaging cyclone since 2018.
Well, Anna, this equity rally just will not quit. That Nvidia investment into OpenAI powering the S&P to a 28th record of the year yesterday. Futures pointing a touch lower this morning, but higher here in Europe. We've had a slower start to the day when it comes to treasuries because of the holiday in Japan, but the 10-year yield at 4.1467 right now. Euro dollar at 1.17 as we wait, as you say, for Powell to speak later. The countdown to the opening trade starts right now.
Tuesday the 23rd, good morning, folks. Who's the most important person when it comes to the future of the US economy? Is it President Trump? Possibly. Is it Jay Powell? We're going to hear from him a little bit later, the Fed chair. Or in reality, is it Jensen Huang, who is keeping the whole thing together at the moment? The AI trade is on, and he is powering it forward, and he's financing it, and it keeps going, as Lizzie says.
Yeah, absolutely. He's on a tear, isn't he, when it comes to deals? And the latest overnight deal is $100 billion into OpenAI. So this is investing in a customer and becoming a shareholder for a customer. So he had to come out and then reassure other customers that OpenAI isn't going to get any preferential treatment when it comes to the supply of chips. But they've taken a stake in Intel recently. They're investing in AI startups all over Europe and the Middle East. So this is a business on a tear. But it's a really interesting tech picture this morning because we've got this Nvidia story and then we've got some other information out of ASM International, which we'll come to in a moment.
Yes, so ASM cutting its second half view because of softer than expected demand, which takes me actually to the Bain report, because it's that demand that is going to decide whether there will be a shortfall. And this is the shortfall that Bain is pointing to between how much you spend and invest on data centres and how much they're going to produce in revenue to cover that expense. And Bain saying that it's bigger than understood, the shortfall $800 billion, and clearly that ASM outlook making us doubt a bit the data centre demand.
Two words spring to mind: vendor financing. I do remember vendor financing from the run-up to 2000. It's a big feature of the landscape. All the tech build-outs, here's your customer, it's short of money, we'll finance it because we can do that, and therefore the whole thing keeps going. Vendor financing, just remember those words. It's used in other industries. And
private credit stepping in to finance it, which is something we'll come to later in the programme.
We'll talk about that a little bit later on. Richard Windsor, in his note this morning, talks about the power requirement as well. Is there enough power to do all of this? Many nuclear power stations are going to be required to deliver the power that's going to be required to power the data centres this deal is all about. It
is a bit worrying, this ASM International outlook, because it does cite lower than expected demand from foundries, from leading-edge logic, which it seems to be the AI story. And so we'll see. I mean, is this TSMC? Is it Samsung? Which of the foundries are they talking about? And what is it that they're pulling back on demanding, and why? Does it tell us something about the AI story? We'll have to watch really closely on that one.
The colour of the US economy kind of hinges on this story, which is why I think maybe actually Jensen Huang is the most important part of this whole narrative, which takes us on to the Fed. So you're going to hear from Jay Powell a little bit later on. But there's this debate growing within Fed circles about where R star is. Love an R star conversation.
Oh, Bloomberg Economics.
The neutral rate.
Book about
well,
precisely.
It's Tuesday. Feels like the morning.
It feels like the morning to talk about R star. So R star is the neutral rate. Stephen Miran yesterday talking about it being significantly lower. He believes that it is significantly lower because of the AI build-out. It was interesting. Neil Kashkari of Minneapolis posted an essay a few days back talking about the fact that actually R star could be higher because of the AI build-out and the fact that you build a load of data centres which require an awful lot of manpower up front but then don't require any going forward from there, and that effectively raises the R-star rate. So there's this whole debate within the community, and you can see the quote from Kashkari there. He's suggesting that R-star is north of 3%. He's saying it's kind of 3%, 3.1%. Miran thinks it's about 2%. That's a 100 basis point gap. Who is going to win this debate and where ultimately our Fed rate's going to go? Because that, again, huge factor, which is a derivative. Is the rate story a derivative of the AI story now?
Well, I mean, the way that AI feeds into the monetary policy conversation is something that we have to watch because it's such a massive theme, and yet most voices we speak to on monetary policy or on the rates environment aren't, it's not one of their go-to topics of conversation, is it? But maybe it will become. Other Fed voices, though, putting the emphasis still much more on inflation. So we were hearing from, Hammock and Muslim, both of them talking about inflation and having lingering inflation concerns.
Yeah, Muslim saying there's limited room for more cuts, Bostic saying there's little reason to cut rates, and Miran's argument really being that the neutral rate is lower because of tariffs, immigration restrictions on the economy, but also tax policy, so therefore rates should be
But
lower.
he feels like an outlier at the moment still. The question is, with change in leadership at the Fed, does he gravitate more towards where the centre of gravity is? And that's where ultimately policy is going to go.
Well, there's an interesting argument on MLIV that basically if you front-load the rate cuts and then you have inflation picking up next year and Trump around the midterms getting conscious about inflation again and needing to fight it, and then if the new Fed chair is political, big assumption, that they're actually going to have to turn hawkish and there'll be hikes.
But yes, but if you get growth and inflation, is that OK? Is that something the Fed can live with? If you've got really strong growth, does actually the electorate go, yeah, well, we'll take 3% inflation, but we're getting very strong growth. We're running the economy hot. It's this whole kind of do we run the economy hot argument, which seems to be part of the whole kind of Miran shtick.
Yeah, and I wonder how hot or not the European economy is running right now.
Yes.
And that takes us on to the European growth story and what we might get from the PMIs.
Indeed, and we'll get a read of that from the PMIs that we get from France, from Germany, breaking in our hours notably, also for the Eurozone more broadly, and then for the UK after at 9:30 a.m. And when it comes to the ECB, most of the Governing Council seem to be saying, we're done, we're there, except the Lithuanian, who's been floating just yesterday a December cut. But actually, that might make sense because you'd have the December forecast by then. But I have to really emphasise that is a lone voice on the Governing Council. Everyone I've spoken to over the past week, including the Austrian, including the Cypriot, saying you need to keep your powder dry, but inflation risk's pretty balanced right now.
Right, which means that if it's not going to be central bankers giving more juice to the European economy and the fiscal budgets are stretched in a lot of places, except Germany, where they're doing what we know they're doing, that it might operate with a considerable delay. For the rest of Europe, where is the stimulus going to come from? I'm going to be watching the German Manufacturing PMI number. That's not been above 50 since 2022, and there is a chance that we get a number above 50 today, which would be, at least back in expansion territory.
Really mixed messages from German manufacturing, though. Rheinmetall, great. Volkswagen, not so great. Chemical sector, not so great. So there's mixed messages coming out of that sector. France, though, France is going to solve all its problems. It's going to be a massive wealth tax. Everybody's really on board with that. Wow, that is we are entering a new realm, it seems, in France. If this goes through, and it does seem as if there's public support for it, how is that going to work and how is that going to affect the economy? I think France becomes a real wild card in terms of the data we're going to see going forward from here.
Well, talking of taxes, really interesting report in the UK when it comes to the fiscal issues from the Resolution Foundation. It's a left-wing think tank. We have to note how important, how influential it is, given that its former boss, Torsten Bell, is now the pensions minister, and they're saying that if they raise £6 billion in income tax, then that wouldn't hurt employees because it would be targeted at pensioners and landlords.
Well, no, they're going to offset it with national insurance. So you bring down national insurance and you bring up, and what that does is
employee national insurance.
Yes, employee. So effectively that broadens the tax base because it brings in pensioners and the self-employed and landlords effectively into the tax base in a way that they're not at the moment.
But you can tell that this is written by economists, because that would be politically explosive to do that.
But we're beyond that point, though, aren't we?
It would annoy every single self-employed person very, very much, and I don't know whether the backlash from that is worth it politically, but that'll be a political choice, I guess. Should we talk about some of the guests that we've got coming up on the programme?
Patrick Brenner's going to be joining us, Schroders CIO multi-asset over at Schroders. Christine Kuhnby-Nielsen is going to be joining us, Danske Bank FX strategist. Giulio Renzi-Ricci, Vanguard head of portfolio construction Europe, is going to be joining us, and Bruce Richards, who I have to say is very much in the we're going to run the economy hot camp, Marathon Asset Management CEO, chair and founder, joining us later in the show.
Coming up on the agenda today at 8:30 a.m. London time, we'll get a Riksbank decision. Looks to be an incredibly close call this time. As we were discussing, we'll also get the global flash PMIs, and then at 2 p.m. more Fed speak. We'll hear from Mickey Bowman, and then 3:30 p.m. Trump speaking at UNGA, the UN General Assembly meeting, and then at 5:35 p.m. London time, the Fed chair speaking as well.
I think that there are going to be some persistent themes at the UN General Assembly, aren't there, that are going to come. There are going to be plenty of headlines around. One is the recognition of a Palestinian state by various European countries and other English-speaking places as well. The Middle East is going to get a lot of mention as well, and the east of Europe as well. So a lot of ways that we're going to be talking about Russia. That's going to be getting a lot of mention.
Who's going to stand isolated here? Is it going to be Iran? Is it precisely? That's ultimately where this is going. Who's going to be the most? Who's going to feel like it's the most isolated in terms of what is happening here? It's fascinating to see France basically pushing back US resistance and pushing towards Palestinian recognition. It does feel as if the groups that are aligning against the United States, it just feels like it's getting a little bit more solid.
Maybe they feel there's some safety in numbers. And on the Eastern European side of things, we get warning after warning from Eastern European leaders talking about how Russia is testing NATO's ability or willingness to respond.
Yeah, but on both points, you could cynically argue, what is the point of recognising Palestine as a state? What does it actually do? And what is the point of a coalition of the willing? If you've got all of these nations talking about how they're going to help Ukraine after there is peace and safeguard it, surely that just prolongs a ceasefire, because Putin wouldn't want all of these nations helping Ukraine afterwards. And surely that's the US view here on both, you could argue.
OK, what else do you need to know this Tuesday morning? Disney says Jimmy Kimmel Live, the programme, will be returning today, ending a brief suspension imposed after he made remarks about the murder of Conservative activist Charlie Kirk. The late-night host personally negotiated his return with Disney CEO Bob Iger and Dana Walden, who oversees ABC. Sources say Kimmel will address the controversy over his Kirk comments when he returns to the stage later today. Donald Trump says his administration is linking the active ingredient in Tylenol to autism and urging pregnant women not to take it. The company says science shows taking paracetamol does not cause autism.
So taking Tylenol is not good. All right, I'll say it. It's not good. For this reason, they are strongly recommending that women limit Tylenol use during pregnancy unless medically necessary.
Shares of the products maker, Kenvue, reversed some losses after the bell, after slumping to a record low on this press conference. And Hong Kong is facing potentially the most damaging cyclone since 2018 as Super Typhoon Ragasa tracks towards the financial hub after lashing the Philippines and Taiwan. Hong Kong's international airport is expecting major disruptions, and schools have been closed on Tuesday and Wednesday, with similar measures being put in place across parts of southern China. The Hang Seng is trading lower on this news.
Coming up on the programme, Orsted shares are called sharply higher. The ADRs were up by 10% in session yesterday after winning a court ruling to resume work on a wind farm that was previously stopped by the White House. Plus, Heineken makes a $3 billion investment in Central America. We'll watch both of those stocks then at the start of trade. Up next, Stephen Miran gives his first policy speech with few surprises, justifying his outlier status when it comes to the dot plot at the Fed. We'll talk about the Fed next. We'll get Valerie's opinion on all of the latest news flow. IB plus BBTV Go, that is the function to use on the Bloomberg terminal if you want to get in touch with the team. This is Bloomberg.
Based on this analysis, I believe the appropriate Fed funds rate is in the mid 2% area, almost 2 percentage points lower than current policy. The Federal Reserve has been entrusted with the important goal of promoting price stability for the good of all American households and businesses, and I'm committed to bringing inflation sustainably back to 2%. However, leaving policy restrictive by such a large degree brings significant risks for the Fed's employment mandate.
The Fed's Stephen Miran giving his first policy speech since being appointed by the US president to the Fed, of course. There he was in his own words. Let's get Bloomberg Valerie Teitel on the case with some analysis. Val.
Well, Miran was really laying out his argument wide and clear for everyone to see on why he thinks that the Feds should be cutting interest rates in a rapid fashion. He all started with an assumption of the Taylor rule of interest and then subtracted all of the Trump administration policies, which have lowered the natural rate of interest. In that table that he gave, immigration and trade weighed the most on the natural rate of interest. And after all the math done through that table, he sees those neutral rates being around 2 to 2.5%, implying that in order to do undue damage to the labor market, the Fed needs to cut in a rapid fashion around 200 basis points to get to that neutral policy stance. He was asked by the moderator, are you panicked? He said, no, I'm not panicked yet, but when I become panicked, I'll let you know. He was also asked by the moderator in the final question what he thought about the Fed's 2% inflation mandate. Now, this is important because we still don't know who the next Fed chair is, and if Miran is elevated to that position, he could have a bigger control on the Federal Reserve policy moving forward. But he did mention that he is not necessarily supportive of the precise 2% inflation target. He is more supportive of going back to the pre-2012 era where the U.S. had a vague inflation target of low and stable inflation, something to keep in mind if he perhaps is promoted come January. But that being said, we also hear from the Fed chair himself later tonight around 5:30 p.m. London time. Jerome Powell will be speaking on the economic outlook. There will be Q&A by a moderator as well. We have just heard from him at the press conference last Thursday, but keep in mind he was speaking on behalf of the FOMC. Tonight he speaks in his own personal opinion. Guy?
Yeah, that'll be fascinating to get a sense of where he sits on the spectrum in terms of doves versus hawks. Valerie, thank you very much indeed. So let's pull it all together. What is setting the tone for these markets right now? Is it what is happening with the Fed? Are we pricing in lots of Fed rate cuts? Is that going to drive equity markets forward from here? Is it the AI trade? We've just heard, obviously, a lot of conversation about where that goes next. The Nvidia OpenAI story. Patrick Brenner is the CIO of multi-assets at Schroders and joins us around the table. Good morning.
Good morning.
Nice to see you. What's driving your thought process at the moment? What's driving these markets primarily in your mind? Is it the expectation that the Fed's going to cut aggressively from here? Stephen Miran certainly would welcome that. Is it the fact that the AI trade is still on? We've got OpenAI being funded by Nvidia, big build out. That keeps that story on track. What is it at the moment that keeps delivering this record high after record high after record high?
Yeah, look, I mean, I think clearly both. The macro is driving the market higher. The AI story is still there. So I think we're still positive equity. We've been positive equity for most of the year. Yeah. And we continue to be so. An environment where the Fed is cutting rates in what we expect to be a non-recessionary environment is very supportive for equity market. So, you know, we continue to believe that our standards, our default positioning should be to be long equity.
Are you getting even more equity? I noticed in the note this morning that I read that you seem to be upgrading your expectations. Like, how much higher could this thing go?
Well, I think it can go higher. Equally, we probably don't want to be full risk on right now because we need to be conscious of the fact that valuation and to less extent positioning are quite stretched, right? So I think you need to keep some dry powder in case we see a correction.
But correction or dip?
I would say a small correction, so anything which is lower than 10%.
Okay.
And we will be definitely buying that. But I think, yeah, but staying in the market, I think, is equally important because you're hearing a lot of people, as I'm sure you know, which are, you know, not participating in the market. Some people are short the market, calling for a dip to buy the dip. But what if the dip never happened and then, you know, the market goes away from you? So I think we want to be in the market. Not full risk on, but we want to be in the market.
Patrick, does it make sense? I mean, the arguments around stocks going higher, we hear them a lot, and there is logic to them. There are lots of logical arguments why gold is going higher as well. But is it logical that both of them should be at record highs? The S&P at record highs, the 28th record high of the year, in fact, and gold prices going higher and touching another record yesterday. Does it make sense that both of them move to records at the same time? And does one of them need to slow down?
No, I think it does make sense for both equity and bonds to go higher. And going back to the previous question, you can see the market is driven by macro, but also by AI, right? And you could argue maybe the equity market is more driven by AI, and then the gold is also driven by the macro. So when you think about gold, clearly we believe that gold should continue to benefit from lower real yield, from a weaker dollar. but also from all the risks that we've been talking about, right? I mean, think about the main risk that every investor talks about, which is about Fed independence, fiscal hangover, sticky inflation. Those are all risks which are very positive for gold. So we think that gold has more to go.
And those things will never hurt stocks, or they don't threaten stocks.
They might at some point, but as long as those drive higher nominal growth and bonds behave in the same time, equity can continue to grind higher. I think the risk is more on the bond market rather than on the equity market.
And given that so much of this equity growth is coming from tech, let's focus on that. This Bain report that we were talking about earlier, really highlighting that shortfall between investment in AI and revenue from it. $800 billion, what they estimate. How worried are you about that shortfall?
I think long term we can be worried because there will be a point where we will ask what is the return on all those capex which has been happening. But I think we're still in that phase where we are in this self-reinforcing positive momentum between higher capex and higher earnings. And I think the news that we had yesterday between Nvidia and OpenAI is the best example of it. So the market is still positive feedback through of higher capex, higher earnings, and we think that can continue for longer.
And when you hear news about, let's say, the visa situation impacting tech in the US, does that translate to worry for you about the AI stocks, or do you just kind of brush it off given the momentum behind them?
Yeah, no, I think that doesn't really worry us on the AI itself. I think where it does put pressure in general is on the supply side, on the labor market, which I think is a concern, and clearly that put potentially more fuel on that, but not so much from an AI perspective.
In terms of kind of how we've talked about gold and equities, the kind of in some ways offsetting factors. Where do you see bond yields going? Because again, there's a whole conversation about whether or not we're going to see QE out of the United States, whether or not the long end can be controlled. Where do you see it? Is it steepeners? Do I take steepeners off? Right? What is the trade in bonds at the moment? Because it feels as if the logic would take me towards maybe a steepening trade, but actually the politics is beginning to take me towards a flattening curve.
So on bonds, we're negative. So we think valuations are not very attractive at current level. And given our concern around inflation and fiscal sustainability, we think that the best expression of a steepener trade is actually to be short outright the 10-year. The issue with the steepener trade, I don't mean people have a steepener trade on, but the challenge with the steepener trade is you need to be really right on the timing because it's a costly trade to own in your portfolio. It's negative carry. So we think that being outright the 10 years is actually the neatest way of expressing those concerns.
So which end of the steep? So if you don't see the steepener trade?
So we would be short 10 years.
Yeah.
Just the short.
So you think that that's the bit that's wrong right now, the 10-year?
Yes, because that's the one which is going to be impacted by inflation and fiscal and concern around fiscal debt.
But there's this view increasingly that the US is going to try and control that through QE. That's what I talk about when I mean the politics. And that's beginning to creep into the language. We'll talk to Bruce Richards about it later from Marathon. He sees QE. Basically, the US wants to control the 10-year because that's the borrowing rate at which a lot of corporates and the consumer kind of buy it. That's the kind of the middle. Also the long end, obviously, for mortgages for the 30. How much political risk is there in the long end of the curve at the moment?
There is probably, but let's not forget that if QE were to come back, then probably equity will rally massively.
Yeah.
Right? So you need to construct a portfolio where you get some hedge as well and try to diversify the risk. So in a scenario where QE comes back on the table, I mean equity will rally very strongly. We want to be short bonds because we want to protect against the risk of having inflation higher or again concern around fiscal sustainability. If QE comes back, bonds will probably do okay, but equity will do even better.
Okay.
Patrick, thanks so much for joining us this morning. Patrick Brenner, CIO of Multi-Asset over at Schroders. So, I mean, there's a lot to discuss when it comes to all of those asset classes. I do wonder, when you're talking about that stagflationary picture, maybe where it leaves the dollar as well, but we're going to be speaking to an FX strategist next. We'll speak to Kristin Kunby-Nielsen of Danske Bank about that. We've also got a whole load of Fed speakers to be watching out for as well.
Yep.
Powell coming up later. As you say, you've already heard from the likes of Kashkari and Miran.
Absolutely. We're going to take on what is happening with the dollar. If you try and control the long end of the curve in the United States, what effect would that have on the dollar? What impacts would we see if we were to see some sort of operation twist coming through, changing the nature of buying at the front end, buying at the back end? How big an effect would that have? We'll talk about it next. This is Bloomberg. Tuesday the 23rd, 29 minutes to go until the start of European equity market trading. At the moment, futures fairly mixed, a little positive, so we rally a little bit, as you can see, up 0.2%. US futures fairly flat at the moment. S&P E-minis are mildly negative. You factor in some fair value calculations, and you basically just get to flat. So that's the picture this morning. Equity markets now looking for the next catalyst. Does it come from ASMI? Does it come from the PMI data? Does it just come from the ongoing trade that we're watching in the United States around Nvidia? All of that obviously needs to be factored in ahead of Powell later on today.
Yeah, and of course for Treasuries we had a later start this morning because Japan is on holiday, but in your European bond space we've got yields a touch lower across the curve, across the continent. Really not a whole lot of movement here, but we've got Eurozone PMIs coming out later this morning, so maybe that will change the picture, but steady waters for now, Anna.
Yeah, a lot of Fed speakers this week, waiting for some issuance, aren't we, in the middle of this week, and also for the PCE data later on. The FX markets will no doubt be watching that as well. Let's have a look at where we've been on the dollar of late. This is the volatility that we've seen in the dollar over the last 5 days. A slight upward drift, it would seem, even if the path of travel from January, of course, has really been downward. So let's talk to Christine Kuhnby-Nielsen, FX strategist at Danske Bank, who joins us on set this morning. Christine, very nice to have you with us. And I think that you are negative on the dollar, but you also think that the market is pricing in too many rate cuts from the Fed. So how do you sort of square that?
Yes, definitely. I think we still maintain this more bearish view on the dollar that we've had for the past many months, I would say, since Liberation Day at least. But I think if we're looking a bit more at the tactical horizon, I think markets are just overestimating the pace of cuts that we'll see from the Fed. I think we're underestimating how we actually can see tariff-induced inflation. I think labor markets, of course, non-farm readings are concerning, but I don't think that the labor market, I would say it's cooling, but it's not collapsing.
How are you thinking about creative thinking from US authorities, whether that's the White House or the Federal Reserve? Because Guy was referencing the possibility we get some kind of Operation Twist, trying to bring down long-end rates, maybe at the expense of pushing up short-end rates a little in the US. Maybe that's a policy priority. Stephen Miran's also been talking about a third mandate at the Fed, talking about long-term interest rates remaining moderate, and that being the third mandate at the Fed. How does any of this play into the dollar? Is the dollar being spooked by these kind of conversations?
Exactly. I think what we should be very aware of if we have any kind of government interference, I think that would be negative for the dollar. I think every time that markets really start to focus on, okay, will we see kind of questions in terms of Fed independence? I think that's something that structurally also just weakens the case for investing in U.S. assets. And I think in that sense, we could get a weaker dollar. So I would be very cautious in terms of extra mandates, looking at the inflation target, those kind of things.
Can I bring us a little closer to home? We've got a central bank with a decision in our hours. Riksbank reporting later. Looks to be an unusually close call this time between a hold and a cut. What are you expecting? Where does it leave Scandis?
Yes. The Scandi central bank's always interesting. I mean, we had Norges bank also last week, surprising, I would say. But we expect the Riksbank to opt for a hold decision, an unchanged decision. We think that inflation is still running a bit too hot, but we think that some of this recovery that really has been stalling would opt them to guide for a cut at the next meeting in November.
OK, interesting. So it comes down to the guidance. Well, we'll watch that when it comes during the programme. Meanwhile, ECB, we were discussing lots of the speakers flagging you don't need any more cuts this year. Is that what you're expecting?
Yes, exactly. And I think markets are increasingly aligning with this view as well. I think looking at that, we are in a good place. I mean, inflation has been 2% for the past 3 months. I think the manufacturing sector is picking up. We got a trade deal. Question is, of course, how favorable that is. But I think just giving some more certainty to businesses. And then, of course, the big joker, the fiscal policy impulse from Germany. So overall, I would say I agree. The ECB is in a good place, and I think they will stick to unchanged rates from here on.
Is Europe going to be okay with 120, 125 euro dollar? When did the numbers start to hurt?
I think that's a great point. I think the FX impact is especially something I would focus on if I was the ECB. If we get a too strong euro, I mean, that would dampen imported.
What's too strong?
Oh, that's a good question. I mean, we have a forecast of 123 for euro-dollar.
Yeah.
It's also, I would say, the speed of the rise in euro-dollar. I think that's what we saw with Brexit. If we get a significant weakening quickly, then that can lead to inflationary pressures. But
disinflationary pressures.
Or disinflationary pressures,
yeah.
Exactly.
So how fast do you think we get there?
We have a year-end target of 123. I think it's been moving quite well.
That's a fast move from where we are now, 118 up to 123 year-end.
In 12 months' time.
Oh, 12
yes,
months.
12 months'
Right,
time.
okay. Not this year.
No, exactly. I was going to say next year.
That would be quite quick.
Exactly.
So, but is that slow enough for the ECB to absorb that kind of a move? Is that slow enough for European business to absorb that kind of a move, or do you think actually that you get to go to those sort of levels? Do you think it puts another 25 bips as a cut back on the table? How connected are those two events?
I would think it's pretty connected. I mean, when we're factoring into our forecast, it does take account to our forecast of 123. So, I mean, in that sense, we would still expect unchanged policy rates from the ECB. But I think it's definitely something to be aware of. But I think that when we're looking at the fiscal policy impulse from the rest of Europe, that's something that's going to be more important for the ECB.
Okay.
Can I ask you about the yen? Hedge funds have a different view from asset managers as to where the yen is going to head. Where do you see, Kirsten, where do you see it heading?
So I think we're going to see the yen moving stronger from here on. I think dollar yen can breach the 140 figure again. I think just in what we're seeing is that the macroeconomic backdrop is so different in Japan than what we're seeing in the rest of the world. I mean, let's see if we get another hike.
Yeah, how quickly or slowly does that materialise?
Yes, exactly. I think we could probably see one already in October.
Okay.
Do you see any repatriation as a result of that? Once rates start going higher, how vulnerable are European government bond markets to a repatriation trade?
Yes, that's a good question. I mean, we're always seeing, or not always, but we're seeing some tendencies, of course, when we're looking at France. I mean, investors, they do tend to become worried when the long end really rises.
Yeah.
When we're looking at the developments in particularly in France, we're also seeing it in the UK. I think it's something to worry, but it's also something that we're seeing in the US. So I wouldn't say it's necessarily like Europe specific.
Okay.
Yeah.
Is that the right impulse to watch for, though? Because, I mean, the Japanese have been waiting for decent rates at home for a very long time. If we start to see them, that is something we would expect to see more of. Where would it show up, do you think?
Yeah, I think that you would get increasingly a home bias for Japanese investors. I think that could be quite interesting. So I think that's where I would look in terms of investor flow.
Christine, nice to see you. Thank you very much indeed for stopping by.
Thank you for having me.
Christine Nielsen, FX strategist at Danske Bank. Staying in that part of the world, Orsted. Big win. US judge has cleared the way for work to restart on a wind farm off the coast of Rhode Island. We'll talk to you about that stock. Other stocks you want to be watching, ASMI definitely is going to be a mover this morning, so we're going to watch out for that one as well. All of that news coming up next. This is Bloomberg.
Welcome back. This is the opening trade. The European futures picture looks modestly positive this morning. We could see some brightness coming through on some of these markets. It's an interesting picture, though, when it comes to technology, and we'll certainly talk about that in just a moment, because we have some positives from the Nvidia OpenAI story, maybe some negatives from the ASM International story, so we'll get into all of that shortly. But for the moment, futures point higher. US futures are pretty flat. Joining us now is Bloomberg cross-asset strategist Ven Ram to talk about the markets in 3 minutes. Ven, where do we start in terms of the broad risk appetite picture? Is it the OpenAI Nvidia story that looks set to create some positivity in the session ahead? What do you think?
Morning, Anna. Definitely the news from ASML is not good for European futures. But, you know, the trajectory of AI and AI-led productivity is one of higher. So I think that, you know, you're going to have these blips in the way, but I don't think it's going to take away from the overall big picture story that AI is going to power growth and is going to boost productivity. But apart from that, we've got the Eurozone PMI numbers coming out today, and that will set the tone for the German bond markets. The French numbers are forecast to show a marginal decline, but that is as it should be, considering that we have had Bayrou stepping down and the numerous protests that we have seen in France this month. So that is going to obviously upset activity there, and therefore the numbers, I wouldn't be surprised to see a marginal decline in numbers. But the more important numbers will obviously be the numbers that are coming out of Germany, where I think that we are expecting to see a slight improvement. So if you look at it in the context of the ECB, what it means for the ECB the ECB is going to stay put on rates. They are not going to use the 25 basis point insurance rate cut that they have got in the bag. They are not going to use that up so easily. So I think that the question, the big picture here is that the ECB is going to stay around where they are for longer.
ASMI, ASML, I think we're going to be mixing that up a lot this morning. Then let's just talk quickly a little bit about where the neutral rate is. There is a debate on the FOMC. Is it 2%? Is it 3%? Are you in the Miran camp? Are you in the Kashkari camp? Which camp is Jay Powell in? Which camp are you in?
I think I'm more in the Kashkari camp. I think that, if very interesting remarks out of Miran yesterday. I think that, his version of the real neutral rate is about 0%. And that is, which means that a nominal neutral rate he sees around mid 2%. Which is somewhat to believe. We have got inflation. We have had an inflation overshoot for so long. And if the neutral rate were as low as he thinks, as he reckons it is, I think we would have seen the inflation come down a lot faster, which hasn't happened, obviously. I think what is interesting is that he is imputing the neutral rate based on what rentals are going to do in the US in 2027, 2028. That's so far out. And so you can't adjust policy 2 years ahead of time, and which is what he seems to be advocating. And I don't think there is, the person on the Fed who has done the most research on the neutral rate is John Williams. He's written a number of papers. He's authored a number of research papers on the neutral rate. And his version of the neutral rate is that it's somewhere around 1%. The real neutral rate, mind you, not the nominal neutral rate. So that'll mean that, the nominal neutral rate is somewhere around 3 to 350. There is no change in that. And I don't think, there is really an excuse for the Fed to go below 350.
All right. Referee Ven Ram settling the debate on the neutral rate for us. Bloomberg cross-asset strategist Ven Ram. Now, Nvidia's investing as much as $100 billion in OpenAI to support new data centres and other AI infrastructure, as Ven was talking about. Is this going to be one of the drivers of the day? We can unpack the deal now with the host of Bloomberg Tech Europe, Tom McKenzie, of course. Tom, just walk us through the details of this deal that we got through yesterday. $100 billion. How far is it going to go?
So $100 billion, 10 gigawatts is what they're aiming for. In the context, 1 gigawatt is about 750. That's about enough to power 750,000 US homes. 10 gigawatts is New York at peak capacity. In terms of the structure of this deal, we don't know exactly when it's going to be signed and going to be implemented, but they say in a few weeks. And the money from the money that's going to come through for OpenAI from Nvidia is going to come through in increments. So when the dealers sign, they'll get 10 billion US dollars. When they get the first gigawatt, they get another 10 billion. So they have to meet these metrics. And obviously, all of this is, at least from the perspective of OpenAI and Nvidia, kind of pointing to how much demand they are expecting to see. Sure. How much demand they're seeing now, how much demand they see into the future. It's really hard. It's hard to keep up with the commitments from OpenAI on data centers. Domestically, in the US, $500 billion was what they announced back in January with SoftBank and Oracle. Now they're announcing another build-out, 10 gigawatts, funded partly by Nvidia. Nvidia also, and this is really important, will get equity in OpenAI as part of this. It's a pretty good deal for Nvidia because the revenue streams from the chips that are needed, maybe 5 million chips ultimately in 10 gigawatts of data centers, that is kind of almost going to pay for itself, if not more, from Nvidia. And they get the equity stake in OpenAI.
I got two quick questions. Is this vendor financing? Because we've seen that in the past, and it doesn't usually end well. Doesn't it? And where did the electrons come from?
Well, where did the electrons come from is still a challenge, of course, and they will tell you that they are increasingly operating with hardware that is increasingly efficient. The new GPUs are becoming more efficient. It's still 10 gigawatts, and that's why you're seeing companies like Amazon and Microsoft investing in nuclear power, for example, to try and meet the needs. They haven't answered that question. That question has not been fully answered. But and this is a reminder. This is a bet on a future that we have not yet seen. And so there are inherent risks to this, and then there's the energy piece.
Have you seen how long
they haven't fully answered?
Have you seen how long it takes to build a power station in the UK? Like a nuclear power station, a big one.
The Prime Minister has said he's going to speed these things up.
Okay, but these guys are moving at a kind of warp speed, and getting permitting for 10 nuclear power stations,
planning.
A bit of an issue.
It all takes a little while, doesn't it? So we've got a couple of things that we haven't talked about, Tom, but I really want your view on. So one is this Bain report that makes us worry a little bit about where the revenue is going to come from on the AI side of things. They're 60% short, apparently, in terms of the amount of capex that's being done and whether they're going to get the revenue back in the future. But then there's the ASM International warning this morning, and that stock cooled down 10%. And they're citing certain types of customers that sound like the customers who make chips for AI. So how much of a warning signal is that?
Yeah, I mean, so with ASM, you have to think about the particular area that they focus on with their equipment. So they're targeting logic chips and analog chips rather than equipment that's provided for TSMC to punch out GPUs designed by Nvidia. There's the inventory question as well in some of those segments of the chip market, and there have been signs that inventories are still relatively high when it comes to analog and logic. And then there's the investment cycle as well. You have to bear in mind, of course, when it comes to the semiconductor industry. I'm not sure it's necessarily a flashing red flag
around the AI story.
Around AI. And we've seen, ASML has been recently upgraded. It's performing very well at the moment. Because it makes equipment, lithography machines that feed directly into. TSMC cannot produce Nvidia's newest chips without those ASML machines. They're not as dependent on ASM International.
So is OpenAI's adventure into building its own chips dead now? I think it's got to be an interesting question. And the other one is, what happens? I thought OpenAI was looking at other chip providers as well. Is it now solely tied to Nvidia for its chips?
So importantly, Nvidia is saying, just because we have an equity stake in OpenAI and many other startups, of course, around the world, it's just OpenAI happens to be the most valuable startup on the planet, doesn't mean they're going to get preferential access to our GPUs, which we know are still constrained in terms of the demand-supply dynamics still there. There is still a gap that Nvidia has to catch up with.
So OpenAI can buy from other sources?
This is still the detail that we need to get, because they happen. You would imagine that the investments OpenAI have been putting into building out and designing its own chips maybe put on ice, but we know they have been working. For example, they had a plan with Qualcomm to look at designing their own chips. So we don't have the answer to that yet, but Qualcomm presumably will want to know what the answer is in fairly short order.
I would.
And Tom, you talked about the power build-out, right, in the UK. The UK has actually got this task force that's going to be established with the US to get collaboration between the two when it comes to capital, but also on digital assets. Is that just, a press release? Is it actually significant? You've had the Nvidia investment in the UK on the Trump state visit. Is the UK actually pulling its weight here when it comes to all of this exciting tech stuff?
Yeah, I think you have to take it relatively seriously, given what the US under President Trump has done around cryptocurrencies and the changes in terms of the regulatory regime there. So I think you have to take it seriously in that vein, and given who leads these efforts, of course, David Sachs over in the US within the Trump administration. If we do have a closer interlink when it comes to cryptocurrencies with the US, there's all sorts of implications, but our regulators are not yet in the same place as the US regulators on this.
Thank you very much. Thanks for the analysis. Lots of threads then when it comes to tech, and they don't all point in the same direction, so we'll see how European stocks deal with that. No doubt that is on the mind of Chloe Melly. She joins us now from our stocks team with a look at some of the stocks that could be on the move. Chloe.
Good morning, Anna. Let's start with Orsted today, and finally some good news for the company. So a judge in Washington ruled that Orsted was able to restart work on a wind farm, which is a major win after the Trump administration ordered Orsted to stop construction on that project. So this should boost the confidence in the US portfolio for Orsted, which has been kind of under repeated attack by Trump, and also boost confidence in that rights issue. Of course, that could also boost the shares this morning, which of course have been on a massive downward trajectory. We can see this massive drop here when the capital raise was announced in August, and continued weakness thereafter. So maybe this little bit of relief will lift the stock this morning for Orsted. So let's keep an eye on that. Moving on, and it might be a little bit too early to talk about beer, but let's do it. And Heineken is buying Florida Ice and Farm's Central American business for $3.2 billion. So that will really strengthen its position in that market and could potentially lift that organic revenue growth in that division, which was actually one of the weakest weakest, as we can see the Americas here, at 3.1% in 2024. Heineken has been underperforming its peers, Carlsberg and AB InBev, a little bit, although they've all been on a downward trajectory. So we'll see how much this deal really changes that picture this morning. And finally, let's move over to France, where L'Oréal is said to be interested in Giorgio Armani's beauty business. So Giorgio Armani said in his will that there were 3 preferred bidders for the brand. So that is LVMH, EssilorLuxottica and L'Oréal. And we'll see how much this potential deal will move the market this morning, although it does leave a little bit of a question mark over that fashion side of the business for Armani, given that L'Oréal would only be interested in the beauty side. So let's keep an eye on that as well this morning.
Chloe, thank you. Chloe Melly from our equities team with some of the stocks in focus. I'm just really fascinated by the way that this tech story plays out this morning, because on the one hand, you've got Nvidia up in the United States. We factor that in. Maybe there's some movement higher in the likes of ASML. But on the other hand, we've got the ASMI story that maybe, as Tom was sketching out for us, operates in a slightly different part of the tech space and therefore is reliant on players, foundries in a different part of the tech space, and therefore is talking about something a bit different. But that's a negative vibe. Both of those are Dutch stocks. Whether the Dutch stock is divided or just falls on the back of this, we'll have to wait and see.
Yeah, does one counter the other? We'll wait and we'll watch. But we come back to the macro as well. Equity markets have been on a tear. At some point, there's going to be a pause. Is that pause coming this morning? Is it going to come a little bit later? What is the next catalyst for that pause? We're going to get PMIs in the next hour as well. How are those going to be factored into the European equity market session as well? It's going to be some interesting trades, I think, over the next hour or so. Yeah,
we've also had earnings out of Kingfisher, double-digit growth in trade and e-commerce sales in the first half of the year. Smiths Group, the industrial tech firm, makes products for security systems, which, of course, we've been talking about, given all the cyber attacks at the airports.
Airport regulars.
Yeah, exactly. They exceeded its guidance for the year to the end of July, so watch both those stocks as well at the open.
OK, so the AEX certainly in focus for us as we watch what happens with that tech story. US futures are pretty flat, pretty unmoved. So to Guy's point about where the next catalyst comes from, I'm not sure it's quite on the horizon just yet. We've got a lot of Fed speakers. We've had some. We've got more to come this week. We've got issuance in the Treasury markets. We'll be watching that, of course. PCE due out at the end of this week. Does that possibly tilt our attention back towards inflation, away from the jobs market? Seems to the Fed very much focused on jobs right now. Coming up, we will bring you the market open here for Europe. Futures do point a little higher this morning in aggregate. This is Bloomberg.
Tuesday morning. Good morning. I think it's going to be one of those days we're going to need to give it 5 minutes until the market opens, beyond the market opening, to get a sort of sense of what is going on. You've got a little to price in on the upside. This is where Europe went out, kind of there. The US market rallied a little bit. I think that's probably why you're seeing European stocks higher this morning. But I think there's a number of different factors that you need to throw into the trade this morning. We've already discussed what's happening with AI. We've got Orsted to throw in there as well. The PMIs are going to be coming through in the next hour. So I think there's a few moving parts over the next hour or so, which can be really interesting to watch to see where we go. But I think at the get-go, Lizzie, positive.
Yeah, is that Nvidia investment in OpenAI lifting sentiment, not just stateside, but here in Europe as well? It's green across the screen for the futures picture right now. Not much so when it comes to the broader Stocks 50 futures and FTSE 100 futures. But look at this recovery that we're expecting for DAX futures after the misery that we saw around the auto space, really affecting Germany. So pushing that higher. But it's going to be a mixed bag, it looks like, when it comes to Amsterdam because of the individual stock story, Anna.
Yeah, a lot to focus on there. Let's talk about some of the individual stocks that could be in focus and the wider sectors that they represent, because that could be something to focus on. So Orsted, wind farms, of course, very topical. A US judge ruled yesterday that Orsted can resume work on its nearly completed wind farm off the coast of Rhode Island. Now, this could be just an Orsted story. That stock, the ADRs, were up by 10% in session yesterday over in the United States. We expect that to feed positively into European trade, but will it take the rest of the sector with it to some degree? ASM International, then, telling us one part of the tech story overnight, and they have warned about the second half of the year. Is this all to do with one of their customers, Intel? We'll certainly dig into that story as we go through the programme. And Heineken, they are buying some assets in Central America. We'll watch that one as well, Guy.
A lot of focus on the Amsterdam market this morning. Let's see how it opens in just a couple of minutes' time. Well, 1 minute time. It's time for the opening trade now. Let's see how it is in a couple of minutes' time once we've got all these stocks open. It's going to be fascinating to see how we trade through the Amsterdam morning. ASMI, ASML, the tech trade more broadly, what is happening with Heineken this morning. All of those are going to be factors for the Amsterdam market to deal with. The FTSE's out of the gates a little positive this morning, but not by much. Stock 600 will wait for the other main markets to open. The IBEX is up by 0.3%. Focus on the banking sector there, but just broadly, let's look at what is happening with the Spanish economy right now, which is a really interesting trade given what else is going on around Europe. The CAC is open. We're up by around 0.5% this morning, so some positive news coming through for the CAC here on. But I think it's going to take a couple of minutes to get the AEX going this morning. There's a lot to digest in that trade. The DAX as well had a really difficult day yesterday with the auto story coming out of Porsche into Volkswagen into the wider sector. But you've got ASMI, ASML, Heineken, plus also the banking story, which remember is in focus as well with the ABN AMRO story that we're watching, kind of trying to figure out what's going to be going on there. So there's a lot going on in the Dutch market, so I'm not surprised it's taking a little while to get going. Lizzie, what's in the sector story?
We've got about three-quarters of sectors in positive territory this morning, Guy. Construction leading the gains up 0.6%. Utilities not far behind. Retail as well. Industrial goods and services in the green too. Bottom of the basket, though, we have basic resources down 0.3%. Tech as well, actually down 0.3%. That answering a bit of our debate about which way that was going to go in. And healthcare at the bottom down 0.3% as well. Looking at some of those individual names, though, Anna.
Yeah, and just to make the point, the guy was saying, you know, the AEX taking some time to open and still not open. And we only have part of the answer to the question about where that market goes, because ASML is down. It's down by 1.4%, which is not taking its lead then from the Nvidia story. We have ASMI that is not yet open, and that's where we've seen the warning overnight, talking about certain parts of their market, certain customers. And interesting, in our Bloomberg News piece, we are highlighting that this is perhaps a business that is servicing, maybe to some degree at least, in the shape of Intel, those who've lost out at the front end of the AI story. And so maybe this is actually an Intel story that we're seeing playing out at ASMI. That seems to be the take there. But technology, one of the worst performing sectors then this morning, and we haven't yet seen all of those stocks just open.
Yeah,
Heineken's up.
Yeah.
Just in the AEX. So you've got beer up, tech down.
Yep. And cars up again. So Volkswagen roaring back up 1.5%. Renault, Volvo, BMW, Stellantis all in the green.
And we were asking whether the Orsted story, how positive that's going to be. Well, we don't know yet because that one is still closed. But Vestas is up by 2.7%. So it seems as if that ruling by a US judge yesterday having at least at the margin some positive impact on that stock.
And we await the start of trade for Kingfisher and Smiths Group after those earnings. But for the meantime, let's speak to our guest, Giulio Renzi Ricci, Head of Portfolio Construction for Europe at Vanguard, for some analysis now. Good to have you with us around the table, Giulio. Let's go back to the macro story, shall we? How many more cuts are you expecting from the Fed? You've got markets hesitant to fully price 2 more, but lots and lots of Fed speak this week.
Yes, absolutely. So the markets, as you're saying, is probably pricing 2 more cuts. So that's a little bit on the Fed side. We're a little bit more hawkish from that perspective. So we're thinking that it's more likely that the Fed will have 1 more cut and setting at a 4% rate for the rest of the year. The main reason there really is on the inflation side, is the sticky part, right? There have been good indicators so far, but still is not quite where the Fed would like the inflation to be, and we're expecting 3% in terms of inflation for the year over the course of the year. So that, of course, puts us in a position where we could see changes in the yield curve, especially on the short end compared to the long end, but that's where we're positioned right now.
And let you say you don't get a growth recovery and you have stagflation, where does that leave the dollar?
Well, that's an interesting part of the trade to some extent, right? Because if we are compared to market consensus, we're expecting the Fed to hold on a little bit more, not to cut so much. From a fair value perspective, the dollar has been depreciating a lot this year, and from our models, it's probably below fair market value, and because of the rates probably not coming down as much as the market is pricing right now, we think that there is upside for dollar to reappreciate over the next few months.
So are you leaning into things that might do better if rates stay a little bit higher than
Correct.
the market?
I mean, from a dollar.
So financials in particular over in the United States, are you leaning into banks? Is that the thing?
Yes, that I think is one of the sectors that, generally speaking, simply because the curve is a little bit steeper now, and we're not really seeing a change in the long term of the rates, so like the 10-year plus. that being anchored, I mean, we have seen that before, that net interest margins are positive when the yield is so steep. And for that reason, we think that financials and U.S. banks in particular might have on the upside.
With the lens that you apply, Julio, where does the AI story sit for you? How at Vanguard are you thinking about the AI story, either in terms of how fast stocks run or what kind of macro impact this has? What's the inflation story? I mean, it's such an enormous investment build-out, such a huge capex. It's got to influence other asset classes.
Absolutely, yeah. So that is the big story, what we have been calling to a large extent a megatrend story for us. And where we're seeing things going is the following. It's basically saying the AI story is a long-term bet on how AI technology would move away from tech into other sectors. And that part of the story will basically position us from a strategic perspective saying, okay, great. If AI is so successful as investors are expecting to other sectors of the economy, well, that will push, all else equal, interest rates to be higher for longer, and also investors to move away from this concentration in tech stocks to other sectors and other industries and other regions in the world.
Why the higher for longer? Is that the inflation side?
Just because of the productivity growth. So productivity, higher growth might lead to higher interest rate. Probably not as high if, on the other side of the coin, to some extent, the fiscal deficit and debt sustainability in the U.S. prevails compared to the growth.
So our star is higher?
Our star is higher. From our base case, our star is higher than what the market is pricing right now, around 3.5% for the US.
3.5? Wow, OK, that's quite a high number.
Yeah.
OK, so the Fed's not going to cut as much. Let's kind of put this all together. The Fed's not going to cut as much. Our star's at 3.5. Fed's not going to cut as much. Where does that leave US stocks? Because US stocks feel like they're being driven by two things, one of which is the AI story, the other one is the rate cut story. If you take away the rate cut story, do stocks go down?
That's a great question in the sense that over a shorter period of time, we are still bullish on a tactical basis for US stocks, mostly because of the Fed hawkish signal that we see. On a longer-term basis, and it goes back to the diversification element, we think that there is margin for diversification there. And again, depending on whether there are two sides. If AI is successful in other sectors, then you might diversify away. At that point, you would have less weight on U.S. stocks because investors are moving money away. If it's not as successful, then valuations are probably too high.
OK, let me come at this from a different angle. At the moment, if I'm a euro investor, euro-denominated investor, the S&P is down year-to-date by 0.1%. I've made no money in the S&P this year because of the currency hedging factor. If the dollar goes back up, does that outweigh the US markets maybe coming down in the short term? Kind of where does that leave me? Because at the moment, the US market's up, the S&P is up year-to-date 14%. But as a euro investor, I've made none of that. So what am I looking at in terms of my signal whether to put money to work in the United States? Is it the dollar story or is it what is happening in terms of the stock story?
Over the short term, I think it's both, right? So we see an appreciation of the dollar over the shorter term, and that is good for European investors that are not hedged. And over the shorter term, I think because of the profitability story. So there is a big difference between, for instance, European stocks and US stocks.
Sure.
Most of the short-term trend in European stocks has been because of valuations, because they were cheap, and valuations have been recouping. On the US side, it's very different. It's mostly because of earnings growth and productivity and profits. And that's what has been keeping them and recouping over the past, let's say...
multiples are still pretty high.
Exactly, but multiples are still pretty high. I totally agree. Over the shorter term, I think that earning component story comes back and prevails. But from a valuation perspective and margins perspective, over a longer period of time on a more strategic basis, that's where we're more cautious.
You also, Julio, like some EM debt. What is it that you're liking specifically? Is it sovereigns? Is it corporates?
Is on the hard currency part. So it goes back, I think, to the USD having margins for reappreciation and taking that exposure from hard currency emerging market debt perspective.
But when it kind of trades EM bonds with equity-like risk, how do you balance that in the portfolio?
Well, absolutely. So that is a consideration of how much risk you want to take into your portfolio, right? So the EM story, the hard currency EM stories for us is for that spectrum of investors that are willing to take additional risk. Considering that all else equal, there is room for being more, let's say, bond-like over the medium to long term, just because of the yield component. And we've been saying this for some time from that perspective. Bonds are back because of the yield component. And if you look at initial yield for total returns over the longer term, that is a good indication of what you might get from bonds.
Just out of curiosity, the debate we're having around the table a lot at the moment is why stocks up and gold up? Do these two things... Why am I buying gold other than the fact that it keeps going up? What is when you get asked that question, what is the answer? Do I buy gold? Do I not buy gold? And if I'm buying gold, why am I buying gold?
I think the gold story is linked to two elements. One is for sure the inflation-related story. Right. So gold, like other commodities, has what we call high inflation beta. So it's a good hedger against unexpected inflation. Right. And we come from a period post-COVID where we're seeing a lot of that. Yep. And so I think that is what has been helping gold being strong for the past months. And I think there is a reason for that. Now, looking forward, I think there is less of a reason for being so cautious about unexpected inflation. I think monetary policy across the regions is a little bit more under control. There is still uncertainty, it's still sticky. But in terms of unexpected inflation, I think there is less uncertainty.
Julia, nice to see you. Thanks for stopping by to see us. Really appreciate it. Julia Renzi-Ricci, Head of Portfolio Construction, Europe at Vanguard. Core 6 looks like this morning. Tech firmly in focus, as it has been, obviously, many mornings. But ASML, as you can see, is down. ASMI is under pressure as well. Some of the defence stocks are also coming off the boil a little bit. It's interesting to see that we do see the French market being driven by LVMH, but Schneider is up this morning. If you want to build all these data centres, you're going to need some power. You're going to need some electrons, and you're going to need a way of making those electrons work, and Schneider does a lot of that. So that stock up by 1.7% this morning. Chloe Melly's got more. Over to you.
Good morning, Gail. Let's start with chip stocks that are down this morning after ASM International cut its outlook for the year, for the second half of the year, given softer than expected demand. So it is down 5.4% on the back of that outlook cut, and really dragging down the shares of those other semiconductor companies, ASML and BE Semiconductor in particular. So this maybe plays out as a bit of a warning for that industry going forward. Moving on to Heineken, which is up this morning on the back of the deal that it has made with Florida Ice and Farms Company, their Central American business. So this will really boost the position of Heineken in places like Honduras, Costa Rica, Guatemala, and this is also a market that Heineken says has a really lot of growth potential. So the market is reacting quite positively to that deal, and we're up 1.7% for Heineken. Moving on to Commerzbank, which is down this morning, a little bit down this morning, 0.9%, after it was cut to an underperform rating at KBW. It said that the benefits from the German fiscal stimulus were already priced in after a really massive rally in the stock, and therefore it cut it from market perform to an underperform rating. Moving on to Orsted, which is also on the move this morning and is up 8.5% after news that it won that court ruling and was able to restart work on the Revolution wind farm off the coast of Rhode Island. And that will really spell good news for that offshore wind industry, and is really a major win against the Trump administration's decision to stop construction on that project. So up this morning on the back of that for Orsted. And finally, Kingfisher, the home improvement company listed in the UK, is up a massive amount this morning, is up 17.4% after boosting its outlook. So we've got one of the most important moves here for Kingfisher today.
Thanks very much, Chloe. Chloe Melly from our equities team coming up on the programme. We'll pick up on the Orsted story that she was just referencing there. An Orsted joint venture wins a court ruling to resume wind farm construction in the United States. We'll have more on one of the biggest movers, one of the biggest gainers on the Stock 600 this morning. This is Bloomberg. This is the opening trade. 17 minutes into our European session, and we get data out of France that sends the euro a little bit lower. And you can see why when you look at the misses that we have on manufacturing PMI, services PMI, and the composite number. So the actual number for manufacturing came in at 48. We had been expecting that to stay at 50. So not in expansion, in contraction territory in French manufacturing. And on the services side, that was expected to be nearly 50 and has come in at 48.9. So again, in contraction territory. So both sides of the economy not powering ahead, whether the politics is weighing buying, whether that's weighing on sentiments for consumers or businesses, we'll see. But that is the slightly negative story that sets up the rest of the day's PMI news.
The quote from the statement this morning: subdued consumer demand was noted as a drag on activity levels in both sectors, manufacturing and services side, with survey data signalling the 16th successive reduction in total new orders. So in some ways this is new. Clearly there's a turnaround from the August picture, which looks like it was stabilising, but there have been sort of 16 consecutive quarters in which we've seen this. So to a certain extent, maybe it is less related to what we're seeing in terms of the political picture, and maybe just a kind of longer-term drag that we're seeing. But clearly there was a kind of stabilisation in August, which has now kind of gone back to being quite a negative picture out of France.
Yes, so perhaps adding to the case for another ECB cut later down the line. Let's see how much the German numbers, the broader Eurozone numbers, balance out this picture.
Yeah, they call it a sobering reality check. That's one of the comments in the statement this morning in terms of the
That
data.
sounds like a Tuesday morning.
Yeah. Sobering, yeah, definitely. Not so much, though, for Orsted, which had a very jubilant Monday. Orsted shares surging this morning after a US judge ruled that Orsted's Revolution wind joint venture, which I think is just off Rhode Island, can resume construction off Rhode Island. The offshore wind farm has been a subject of, obviously, considerable controversy with the Trump administration. The Trump administration stopping the work order, and that had a fairly dramatic effect on Orsted's share price, which is now bouncing a little bit. Will Mathis joins us now for more. So what did the judge say, and what happens next?
So this is a lawsuit that Orsted brought against the U.S. government to allow them to keep working, to overturn the stop work order. And what they asked was that while this case is pending, that they be allowed to resume work, because if they don't, they would incur devastating costs, really. And the judge yesterday ruled with them. He said, while this is ongoing, you can resume work because, A, I think you're going to win, and B, the cost will be really devastating for you.
Yeah, tell us a bit more about the costs of not working in this situation then, Will.
Yeah, so we got a little insight last week because, little detail, Orsted is raising 60 billion Danish kroner, over $9 billion US dollars, the biggest such capital raise for a European energy company in over a decade. So they came out with a prospectus where they said that every week that they can't work, it's costing them about $25 million. And not only that, but come end of September, there's going to be sort of a cliff edge in costs where if they aren't allowed to resume working, that those costs are going to ramp up so much that it's possible that they would have to cancel the project outright, which would be...
And is that because they've just already committed to spend the money, or, these are not variable costs that just disappear if they don't work?
It's because they have suppliers, they have contractors, particularly these really specialized ships where there are only a handful of them in the world that can actually install offshore wind turbines, which are huge pieces of equipment, bigger than this building that we're in now. And if you have a contract, there's a certain period where you have that ship available to you. And if they have this delay, then maybe they're going to need to open up that contract, get new ships, get new contracts at today's prices rather than the prices of a few years ago.
So the delay itself costly then, Will, but that green on the screen that we're seeing right now, does that signify that the winds have changed for the sector? Is this the start of a turnaround?
Orsted would certainly hope so. If we were to zoom out on the chart of Orsted shares, it would still look pretty bad because, they have come out and said, we need, $9 billion to be able to keep executing on our business plan. But what they have said is that this money will allow us to turn a page. It will allow us to return to growth, deliver these projects, which are going to earn us a lot of money in the coming years. And if they can build, it could be looking back some years from now that this will be seen as a turning point, that they are able to start delivering on that promise.
OK. Will Mathis, Bloomberg's energy reporter, we thank you so much.
Well, in some ways, this connects to the tech story that we've been talking about this morning. What does this produce? Where does the energy come from? Does it come from nuclear power plant? Does it come from fossil fuels? Does it come from renewable energy? I think it's probably going to have to come from all of them if we're going to power the data centre story that we've been talking about all morning. This is the picture at the moment that we've got on the screen. ASMI is down by 3.8. ASML is down by 1.1. BE and Comet are actually both positive on the day. It's a really difficult picture to analyse this morning because you've got the Nvidia story, which is quite positive. You've got the ASMI story, which is a little bit negative. Remember that ASMI has cut its outlook. We were talking earlier on about this relationship with OpenAI and what OpenAI is going to do with its chips going forward from here. It's the relationship is with Broadcom, not Qualcomm, in terms of the chip design. That was that was what we should have been talking about, and whether or not that proceeds. So if we said it was Qualcomm earlier, we meant Broadcom.
Excellent. That's cleared up. But it is a really confusing picture then when it comes to the tech story, because US futures, I mean, they had yesterday to react to the Nvidia OpenAI story, didn't they? And we saw Nvidia shares go higher on that, so that's not proving to be another catalyst. US futures are flat to negative, and the AEX is certainly an underperformer today on the back of that weakness in ASMI.
Well, let's dive into that. ASMI cutting its outlook for second half revenue, citing lower than anticipated demand and a, quote, mixed picture for some clients. Joining us now for more on that is our Amsterdam Bureau Chief Dasha Afasnieva. Dasha, good to have you. What has actually been the problem for this manufacturer of chip-making machines?
The way ASM, good morning, the way ASM has put it is that there's been a mixed picture for some of its logic clients, which means that some of, particularly the segments that deal with the most advanced chips that are needed for AI for the big expansion have struggled. They've also said that there's been a slowdown in kind of analog and other kinds of chips. So the concern here and the reason why we care, I guess, is the extent to which this is a verdict on the chip-making industry, which is a bellwether, which we care about. All of these hundreds of billions of dollars that are set to be invested in AI, and we're interested in whether the pace of that investment is happening quickly and as anticipated.
So is there a read across into the rest of the kind of the semi-sector? The semi-sector is huge, and not everything is connected to each other. So is there a connection to other parts?
So in a sense, you need lots of different kinds of very complex equipment to build a semiconductor fab. And a lot of it you kind of can't do without. But what ASM does is very, very different from ASML, for example, another Dutch company which makes lithography machines that you also can't do without. So on the one hand, there's this read across because you need all this stuff to build super sophisticated chip factories. But on the other hand, there's a degree of competition between some producers because companies, chip producers can decide, do they want to invest more in upgrading in their lithography machines, or do they want to splash out on deposition tools, for example, of the sort that ASM makes that kind of add layers of different materials onto the chips. So there's not a total read across. And I think in the last few months, there's been this sense that recently ended that ASML, for example, would suffer a weak 2026. And then we had a string of analyst upgrades that maybe suggested that concern was excessive. And now we're seeing, ASMI a bit more on the back foot.
Yes.
So it's both a verdict, I guess, on confidence in the sector, but there is some competition between these semicon equipment makers that make very different things, different parts of the process.
OK, Dasha, thank you very much. Dasha Afanasyeva joining us there with the latest on ASMI. And in the piece, in our reporting, the team goes on to make the link between ASM International and Intel, and not with the Nvidia side of things. So if, to your point about all these chip makers and chip equipment makers making for different requirements in different parts of the tech space, then maybe it's the troubles that Intel has been having before it got lots of interest and investment from other people.
And a pitchman in Donald Trump.
Yeah, exactly.
But the bigger picture is there's a lot of money pouring into all of these spaces at the moment. So yes, they may be different stories, but in some ways, do they all ultimately connect?
Does one squeeze the other as well?
Precisely.
Coming up on the programme, we'll dive into the world of private credit and wider markets. Bruce Richards will be with us, CEO, chairman and founder at Marathon Asset Management. Private credit will be a part of the conversation. That sector putting up a lot of money for the AI build-out. We'll talk about that. This is Maybag.
This is the opening trade. We're 30 minutes into today's session, and this is the picture so far. Green across the screen. It's been a busy day already so far in terms of economic data. We're about to bring you the Riksbank decision as well. We're waiting for Chair Powell to be speaking later on, and we've already had a load of Fed speak, and it's only Tuesday. But look at the picture right now. The CAC outperforming here, up 0.6%. What you're not seeing is the misery here in Amsterdam, coming down partly to that ASMI downgrade for its forecast ahead. Misery in Amsterdam seems to be the underperformer across the European continent, Guy.
It was really interesting. Yesterday's session in the United States, yes, positive, yes, driven by tech, yes, the Miran factor was in there as well. But take a look at what happened in volume terms yesterday. It was a really unconvincing session, I thought, at the back end of the day. I looked at it and volume's down kind of circa 20%. The market's not engaged. Yes, we continue to see rallies. But actually, was it a real rally yesterday? But what it has done is bled through, just from an arbitrage point of view this morning, into the European picture. As Lizzie just says, we are seeing highs. In fact, you've got 450 stocks higher, 140 lower. There's some interesting lowers this morning, which is worth paying attention to. Volume's actually quite positive, which is different to what we saw yesterday in the United States. It's not massively positive. We're pretty much on average. In terms of the 52-week high, Smiths is out with numbers. The industrial company out of the UK, up strongly this morning. That stock is flying. We're up by 4% on that one. Asia Brown Bavaria, the Swiss-Swedish engineering group, also tracking higher this morning. It's up by 1.31. Prysmian out of Italy is up by 1%. So some of the engineering stocks are looking fairly favourable. But this morning, I don't know, it feels like we're waiting for the next catalyst to come through. We saw what happened yesterday. I'm not sure the US session was that convincing, but we'll see whether or not we gain some traction a little bit later when we hear from Powell, Anna.
Yeah, as we wait for that catalyst then, Guy, there's plenty of political speakers on the horizon. Let's tell you some of the other stories that you need to know about this morning. French President Emmanuel Macron has formally recognised Palestine as an independent state. The move follows similar action by the UK, Canada, Australia and Portugal. In a speech at a UN conference, Macron also called for an immediate end to the war in Gaza. The French Prime Minister added Paris could open a Palestinian embassy once hostages held by Hamas have been released and the war is over. Disney says Jimmy Kimmel Live, that programme, will return today, ending a suspension imposed over his remarks related to the murder of the conservative activist Charlie Kirk. The company says it reached the decision after having, quote, thoughtful conversations with the host of the programme. Bloomberg is told Kimmel will address the controversy over his Kirk comments when he returns to the stage. And on to tech news. Nvidia says it will invest as much as $100 billion in OpenAI to support building new data centres and AI infrastructure. Bloomberg has learned that Nvidia is making the investment in cash and will receive OpenAI equity as part of the deal. Nvidia assures customers that its investment won't change its focus or impact chip supply. Some of the top news stories there then, Lizzie, and we have breaking news.
We do. From the Riksbank, they have cut the policy rate to 1.75%. The estimate was to keep it on hold at 2%, so a surprise here. It was a finely balanced decision between a cut and a hold. Sweden obviously seeing this ongoing economic weakness, a soft labour market. Our economists actually had seen a quarter-point cut, and you're seeing them actually giving some quite hawkish commentary, actually, so saying that the rate is going to remain at this level for some time to come. So interesting to see the currency reaction. The krona, Swedish krona, weaker now against the dollar by 0.2%. And they're saying actually that the krona is going to be strengthening somewhat in the coming period. So contrast that actually to the SMB. That's expected to hold at 0% for now. But this surprise from Sweden's Riksbank.
Yeah, it seems the thinking evolving then, going from an expectation of either a cut or a hold to setting up the market for staying here for quite some time. Let's talk about some German data which we have hitting the Bloomberg terminal this morning. We've already had French data this morning in the shape of PMIs. That disappointed. Let's have a look at the German figures. Well, the manufacturing picture, certainly disappointing. Once again, there was a chance this number would have gone to 50. That was the estimate, but we have not achieved that. 48.5 on the German manufacturing PMI. The services number, though, does come in much stronger than expected at 52.5, so back into expansion territory in services, which means that the actual composite number isn't a million miles away from where we were, and the euro is confused, perhaps, by that. We dropped on the French data earlier on, Guy, but now pretty flat on euro-dollar.
The commentary with it. Trouble seems to be brewing in manufacturing. Sure, companies have been ramping up production for 7 straight months, but new orders took a nosedive in September. You do wonder whether we're kind of a little bit of a sort of pause, a hiatus period in the German economy before the fiscal kicks in. And we start to see maybe some more positive news coming through. That's the picture coming out of Europe at the moment. moment, it remains a little bit on the confusing side, as it does stateside right now. What are we going to see from the Fed going forward from here? You've got this real debate which is opening up about where our star is, how far the Fed should be cutting at this point. Should the Fed be running the economy hot? Is that what the administration ultimately wants? Let's get a view on all of this. Bruce Richards is the CEO, chair and founder of Marathon Asset Management and joins us around the table this morning. Bruce, great to see you.
Good morning, Guy.
On this side of the Atlantic. You think they're going to run the economy hot?
Well, a few things are happening here. So since September of last year, 1 year later, the Fed has now reduced rates by 125 basis points.
Yep.
And that brings us to 4.25, 4 to 4.25. The Fed, no doubt, will go to a neutral rate, which is 3%. So they have 125 basis points to go. So they're only at their halfway mark. So that's the first thing.
Yep.
They've only eased one time this year, but they have a lot more to go because jobs are slowing. And more importantly, the neutral rate is much lower than the rate we have today. And that's actually restrictive for a lot of the cohorts that need lower rates. The housing market, the construction market, a lot of the mid-sized businesses all thrive in lower rates, and this restrictive rate structure that we have here is actually holding back economic growth. So despite a 3.3% GDP growth last quarter and what's expected this quarter, jobs are weakening, and with that weakness in jobs, despite higher inflation, the Fed has now embarked upon an easing cycle that will last for some time.
Okay. Is Powell doing a good job right now? I want to get your take on that. And who's his successor going to be? And the question everybody's asking is, are we going to see QE from the next Fed chair?
Powell did a poor job at the front end because of the transitory inflation stance that he took that allowed inflation to run very high.
Is he behind the curve now?
And they raised rates 525 basis points in a very short period of time. And he's a bit behind the curve now because the neutral rate should be 3. He's been a bit stubborn. He's been a bit late. And so jobs have been weak. And he now feels the pressure that he can't let this slip away. Despite the economy running well, it's not running hot. Despite it running well, he sees signs on the horizon that the economy may weaken if he leaves rates restrictive, which they've been. And so the next, as you mentioned, the next Fed chair is coming into place next May, which is less than 8 months from now. And 8 months from now, you'll have a Dove take that office as the next Fed chair. They're going to bring rates almost immediately down to the neutral rate of 3. But I believe it goes more than that because 8 out of the last 14 times, and this is really important, that the Fed has lowered rates by 100 basis points or more, and that's happened over the last 60 years, 14 times. 8 out of those 14 times, longer rates have actually risen. And what we've seen right now, since the Fed cut last week, which is September 17th, we've seen long rates actually move up, the 10-year rates move up. So I think the next Fed chair is going to do probably QE with a twist, and the twist is buying longer-term treasuries to bring those rates down, which will be stimulative to the economy, because long rates being higher is not productive for the economy. Take a look at the housing market, for instance. The average housing mortgage rate in the United States is 6.4% today. The average housing mortgage that exists today is 4.1%. So that 230 basis points gap is golden handcuffs for a lot of homeowners that don't feel the incentive to be able to move because mortgage rates are too high for whatever they buy and doesn't provide incentive for those that want to buy. And so housing activity, construction activity is too restrictive right now with rates where they are. And so there's a lot of pressure on the Fed.
Bruce, we could come into all of that. There's so much to unpack, whether it's the housing market, whether it's QE. But when we're talking about that next Fed chair and the probable alignment with the president, I'm looking to the midterms next year. And if you're running the economy hot, if you have inflation high, and are you not underestimating the extent to which the president needs to look tough on inflation at that point, and by extension, the Fed chair as well, and therefore we could see hikes?
So this level of inflation of 3% is not ideal. 2% is ideal. But I think the government is quite comfortable running with 3% inflation. They'll never say it, but I think they're quite comfortable running with that as long as you have growth, because the big deficits and the OBBA, the big, beautiful bill that was passed July 3rd, leads to deficits. And so how you get out of the deficits is A, growth, and B, inflating your way out. If you can have both at the same time in a balanced way, that's actually the perfect formula for the U.S. government. because they need to inflate their way out while growing their way out. The preference is just to grow the way out, but a little inflation probably isn't bad from their perspective.
But are we not putting too much emphasis on who the Fed chair is and underestimating the hawkish core? I'm listening to the likes of Bostic and Mussolem, and they're really not comfortable with running the economy hard.
And so Bostic runs the Atlanta Fed, and Atlanta Fed has GDP Now, and right now GDP Now, which has been better than most blue chip economists besides Bloomberg. GDP Now is projecting for the third quarter 3.3% growth rate. But when you look forward to, for the third quarter that is, but when you look forward to 2026, I think most economists and the Fed is probably in their models projecting a 2% growth rate. So I don't think the economy is running too hot, but I think they're concerned with inflation being above what is their 2% objective. And so they're looking the other way in inflation right now, the Fed, to weak job data, which is the economy, in order to justify lowering rates. And they need to bring rates down because rates are too high. Look at the ECB. Christine Lagarde has already brought rates down to 2%, and here the U.S. Fed is 4 to 4.25.
Okay.
Clearly, the rate should be 3 or lower, not 4 to 4.25.
Okay, so you think rates should be lower, that's clear. I want to ask you about the transmission mechanism through the US economy, because in days gone by, we would have just had banks lending to companies and financial markets, and now we've got private credit lending to companies. And so I wonder, what's the relationship between these rates that people worry about at the longer end and the rates that companies are actually paying right now? Because there's a lot of competition for those clients, which is arguably bringing down some of the borrowing rates for companies as they try to invest in their future.
So I'll answer your question, but look at the most sensitive sector in terms of lending, and that's actually commercial real estate. And what you've seen is when rates went up, commercial real estate got hammered, both the cash flow that you generated from a property that was highly financed, as well as what it meant for cap rates. And so bringing rates down will help commercial real estate in a very big way. As it relates to businesses, what businesses are most highly levered? Look at the LBO community, for instance. It's been a tough stretch for LBOs as of recent, and I think that's behind us because deal flow has been cut in half because financing rates have been too high, number one. Number two, deal flow has been cut in half, and so the DPIs or distributions have also been cut in half from their normal level. Less distributions, less investments. You bring down financing, you'll accelerate the leveraged buyouts and M&A activity and any sectors of the marketplace that are levered in order to do transactions.
Okay.
And so it's very, very positive, I think, for the LBO community, for the private debt community, because when LBOs are more active, then private debt, which provides around 50% of that financing for that acquisition, will also be more active. So I think it's going to be a bonanza looking forward, not looking back, but looking forward for the LBO and buyout community and for private debt lenders. And the businesses will enjoy better cash flow, free cash flow, when they have less debt service with lower rate structure.
And some of the businesses that are investing right now are investing in a huge build-out of capital expenditure, huge AI investment taking place, and I suppose the cost of doing some of that comes down if rates are lower. Are you at all concerned about any of the sort of canaries in coal mines, worries about too much money going into AI right now, or are you're all in?
Certainly. I mean, 70% of all venture capital expenditures right now, or the spend, is going into AI-related businesses. And so that's a big bet on AI, and rightfully so. It's the most exciting opportunity, I think, for the venture community in some years. But we're lenders at Marathon, and we want a principal back, and we want to make sure we have guarantee of our interest. And so we're only lending when you talk about like the data centers in this sector to the most stable, most embedded, well-capitalized companies in this sector, and not to sectors that or segments of this sector that we would consider to be the neophytes or the young companies that don't have a clear path to revenue or don't have a $100 billion plus market capitalization in terms of how you value the company.
How much of your lending over the next 5 years is going to be to AI? Just in terms of the business, how much of the business is AI now?
I think of it a little less AI and a little bit more what's around data centers, because we want to be.
Let's include data centers.
So we want to be.
Is that the big focus of the business now?
So, in the United States, we think the expenditure in the data center area is around $3 trillion need in the next 4 years.
Yep.
Half of that is equity, and about half of that will come from, lending and leases and the debt markets.
Yep.
So let's break that down for a second. The big companies like Meta and Google and Microsoft and AWS, these big companies are IG, and they'll be able to invest or raise capital through the debt markets for some of their spend, in addition to free cash flow.
Yep.
Now, when it comes to building, buying the land and building the metal, the data center itself, that'll come from the CMBS market. And so the CMBS market is about $1 trillion in size, and we think that's about $100 billion that will come into the CMBS market.
Yep.
Capital formation based upon land and the metal or the box itself. Now, what's inside the box, which is everything from wiring to racks to chips being the most expensive part of that, of course. What's inside the box can be financed in the ABF market or the ABS market. And so you'll also see about $100 billion that comes from,
But this is
ABS
all
market.
debt finance. There's a lot of debt financing.
A lot of debt financing. So we think out of $3 trillion spend that's needed, about $1.5 trillion will be equity, about $1.5 trillion will be debt, and out of that $1.5 trillion, the biggest component will be private credit, 60%, we believe,
Will it
which
be
is
60%
$900 billion.
of your business? Do you think this will be 60%?
So we're only going to be financing, again, the biggest, strongest, $100 billion plus type of club that's already established businesses that have escape velocity in terms of their business model, that are the most creditworthiness.
But this is the bulk of what you're doing going forward. Is this
a component,
the biggest opportunity?
This is a component of what we're doing and represents a wonderful opportunity, yes. But you stay away from the neophytes as a lender.
Yeah.
You let that be funded purely with equity, and you see where that leads to, and we only lend to the strongest creditworthiness partners that we know we're going to be repaid.
But there might be some failures.
Yes, right. So, Bruce, are you worried about are you worried about any overheating anywhere, any asset class you look at? I mean, you clearly think that the rates need to come lower, and you're supportive of that move from the Fed. But are you concerned that anything goes too far? Overheating in stocks, in the AI capex story? Where do things look toppy?
Sure. I mean, do I think there's a bubble? Let's start with private equity.
Okay. Yeah.
Definitionally, there can be no bubble in private equity. I'm going to make a blanket statement. Why? Because the average multiple that private equity pays is 11 times for their purchase. Compare that here in Europe with the average multiple being 17 to 18, in the U.S. being 22. It's a nice discount, and it's exactly in the range of 10 to 12, where it's been the last 3 years, 5 years, 10 years. And so paying 11 times to buy a business is not a bubble. And if you don't have a bubble in private equity, definitionally, you do not have a bubble in private credit, because private credit is only putting up 50% of that.
So you don't see any failures in private equity firms?
So there will be bad investments that are made, for sure. Companies, private equity will certainly, Anna, overpay for certain companies. But I'm saying as a blanket statement, I think the toughest times are behind for the LBO private equity space because rates are going to be coming down. That's a positive tailwind. The economy looks fine. And we believe that with deal flow being 50%, and distributions being 50% of what they had been historically, will start to then trend back towards the mean. And so we see clear skies ahead, but certainly in certain segments of the technology sector and in the venture sector, yes, there will be overexuberance that occurs. And it occurs because we're in this period, maybe the first or second inning, but we're in the early period.
How many innings are there?
in U.S. baseball, we're going into the postseason, there are 9 innings.
Okay. Just checking.
In for the long haul.
More of a cricket fan. Bruce, great to see you. Lovely to see you.
Nice
Thank you very much
Thank
for
you,
stopping by to come and see us. Bruce Rich is the CEO, chair and founder of Marathon Asset Management. Coming up, we're going to turn back to geopolitics. Baltic leaders say Russia is testing NATO's readiness to respond. We're going to dive deeper into that story. Tusk was talking about shooting down Russian jets yesterday. It's getting pretty heated out there. We'll talk about it next. This is Bloomberg.
Welcome back to the opening trade. Lithuania's president says that Russia is testing NATO's readiness by repeatedly sending armed fighter jets into the airspace of its member countries. His comments come after 3 Russian fighter jets entered Estonian airspace last week. Estonia's foreign minister says Russian President Vladimir Putin is testing NATO's unity.
Putin is playing is a fire, and next time if we see the immediate threat to our territory or to us, it can be different. So Putin is trying to escalate and also trying to test our unity and capabilities, but he's failing normally.
So as we work our way towards the UN General Assembly, let's bring in our Europe correspondent, Oliver Crook. Give us some context then as we head towards those meetings of just how bold these latest manoeuvres by Russia have been.
Yeah, that's right. The Estonian foreign minister came on Bloomberg television just after, testifying before the United Nations, in which he really detailed what the actual flight path was of these 3, what he said, combat-ready, fully armed MiG-31 fighter jets by the Russians that really sort of went 10 kilometers into Estonian airspace, he explained, and then 100 kilometers staying within it for that period of time. And this was done just outside the capital of Tallinn, just a few minutes away. He said the Russian jets were from the capital. So again, being perceived quite clearly by the Estonians and many within NATO as a sort of deliberate attempt to test the waters to see what the reaction mechanism is of NATO. And we should say that NATO does not at this point have a reaction mechanism to how to deal with these sorts of threats, which is why the North Atlantic Council, these sort of NATO diplomats, are meeting today in Brussels to discuss basically what the next steps are going to be. We're going to be speaking a little bit later to the Estonian Prime Minister after those consultations to basically figure out, does this mean, like the Polish have said, that you're willing and ready to fire upon jets, Russian jets that violate your airspace? That is really the fundamental question that we have to ask ourselves after the last couple of days. And the other question we have to ask is to what degree the United States, in its commitment to these Baltic nations, how firm that is. We've heard from Donald Trump a couple of times over the last few days saying that he didn't like what he saw. He was asked whether or not he would come to the defense of Baltic nations and Poland, and he said that he would. That being said, an invasion of these countries is something quite different from basically taking Russian planes out of the skies with air defense, and that is going to be a real conversation that they need to evaluate over the next coming days. I mean, we will go back to history just very quickly at the sort of the most recent example we have of anything like this. It was outside of Turkey over Turkish airspace in 2015 when the Turks shot down a Russian aircraft. That caused a huge sort of diplomatic issue between Russia and Turkey. It did not create an armed conflict. It ended with President Erdogan writing a sort of letter of regret to Putin. But these are the sort of examples we need to draw from in trying to evaluate how NATO is going to look at this going forward.
Yeah, try and get some answers a little bit later on, Ollie. Looking forward to your conversation with the Estonian Prime Minister later today. Ollie Crook, a fascinating conversation coming up. Stay with us for that.
Also today, we're going to be hearing from the Fed Chair himself, Jay Powell, speaking just after 5:30 p.m. London time this afternoon. We'll have live coverage, of course, on Bloomberg TV. Interesting to get his personal view here when we've already heard from the likes of Miran and we've heard from Hammock, Muslim, Bostic, throwing his hat in the ring.
Yeah, how different is his view of where neutral is, how low rates should be from Miran in particular? That's going to be something we're going to be watching for. And that's going to be the new information, I suppose, given that we've come so recently from a Fed meeting.
Is he thinking about his legacy? Is that the next kind of thing he's thinking about right now? Where does my legacy take me? Where do I fit into the pantheon of Fed chairs? My term is coming to an end. How do I want to leave it?
And lots of speakers from a geopolitical lens, lots of speakers at the UN General Assembly, including President Trump, of course. So those news lines will be crossing a little bit later. Bracing for some data out the Eurozone on PMIs. That's coming up shortly, and out of the UK. That'll be in the pulse for you. That's coming up in the next hour of programming. That's it for the opening trade. This is Bloomberg.